So now we will move on to the CAPM, which is also called as a capital asset pricing model. So in finance, the CAPM is a model used to determine theoretically appropriate required rate of return for a security. So CAPM can be used as the KE. The KE then flows into the WACC. The WACC then becomes the discount factor. The discount factor is used to value NPV projects, and NPV will tell you to accept or reject a project. So ensuring that the CAPM is right leads you to the selection or rejection of a project itself. So ensure that you get the CAPM model right. Okay. So CAPM shows that the expected return on a security is equal to the risk-free rate plus a risk premium. Okay. So which is based on that security. So we'll look at this point in detail. First we look at CAPM graphically. So CAPM is actually not applied to projects, it's actually applied to shares. So what we'll do is we'll see like how this concept is applied to the share market. So if you're going to own shares, okay, or stocks, if you're going to buy one company's stock, it's very risky. If you buy two companies stock, it is little bit risky. If you buy 20 companies stock, your risk actually falls a lot. I think you accept this, right? Having one, if you buy just one company's share, and if that company closes, all your 100% of money is gone. If you buy two companies share and one company is closed, still 50% of your money is lost, 50 is saved. If you invest 100 rupees in 20 shares, and if one company gets closed, then only 5% of your money is gone. So it is always better to have a higher number of companies to be bought in your portfolio. Okay, so portfolio is a collection of companies, so you should always have a high number of companies in your portfolio. Okay, so this red line depicts how your risk falls, right? The more the number of companies you buy, your risk falls. So I think you accept that, but that's a problem. How many ever companies you buy, some amount of risk is always there. Okay, whatever you do, that risk will never go out of your consideration. Okay, so the risk that you can mitigate or you can overcome is called as unsystematic risk. The risk that you can't overcome at all, okay, you have to suffer that is called as systematic. Okay, so what are the different types of systematic risk? For example, how many ever companies you own, there is a political risk. How many ever companies you own, there's an economic risk. How many ever companies you own, there's an inflation risk. Okay, you cannot overcome these risks. They are a part and parcel of shares. Okay, so systematic risk is an important concept. Unsystematic you can go away with, systematic you have to live with it. So we look at the concept again here. So systematic risk, the total risk involved in holding the securities, divides the risk into specific risk specific to the company and the risk due to market variation. Okay, so systematic risk is something you have to live with. Unsystematic risk you can diversify. Unsystematic risk can be diversified, they can be thrown away. The more the number of companies you have, your unsystematic risk gets wiped out. Investors may mix a diversified market portfolio with risk-free assets to achieve a preferred mix of risk and return. In simple ways, systematic risk stays, unsystematic risk can be thrown out. So again we'll see graphically the same graph. Again we'll look at the concept. Unsystematic risk can be thrown away. Systematic risk will stay in your company. It's a very important concept. You have to remember this. And unsystematic risk can be measured through something called as a beta. So again remember this very well. So now we'll move on to quiz. As the number of stocks in a portfolio increases, the portfolio's unsystematic risk, what happens? Can increase or decrease? No, it only decrease. This is wrong. Decrease at a decreasing rate? The more the company you have, the more the risk will fall. The more the company you have, the risk will fall. Okay, but it will fall at a decreasing rate, not at an increasing rate. So let's see the answer. The answer is B. Increase the number of shares stocks in a portfolio, unsystematic risk will decrease at a decreasing rate. Why it decreases at a decreasing rate? Google it and you will try to find it. So now we'll move on to the next concept called as related and correlated risk in CAPM. See, if two series of shares or any asset, if they move together, it is called as positively correlated. If the series of returns in two assets are moving in opposite direction, it's called as negatively correlated. The existence of a perfectly correlated, especially negatively correlated projects is quite rare. Okay, in reality it's like very difficult to find two assets which are giving exactly opposite results. But in order to diversify project risk and thereby reduce the firm's overall risk, the projects that are best combined or added to the existing portfolio are those that have negative or low correlation risk with existing projects. Okay, so it's something like this. If you have eggs and if you place all those eggs in a particular basket, so if you place 10 eggs, okay, you place 10 eggs in a particular basket and the basket breaks, all the 10 are gone. If you can place all the 10 eggs in small different boxes, even if one breaks, the other will remain safe. So the concept works like this. You should have assets which are low correlated or negatively correlated. Okay, so that's how it happens. But in reality, projects would usually be like positively correlated. So that's how reality works. So we look at the real case. So this is what they tell in terms of related and correlated risk. This is project A. Project A gives you a cash flow like this over a period of time. Okay, we'll take like this to be January and this to be like August. So every January it gives you a high cash flow and every August it gives a low cash flow. There's another project. In January it gives you a low profit, but in August it gives you a high profit. Okay, when you combine both, the cash flows get adjusted towards each other. For example, if you want a much simple example, assume that you are having a shop. In your shop you are selling in summer ice creams. Okay, this is in summer. In winter you will suffer income loss. So what you do is, in winter you sell raincoats, okay, or sweater. You sell sweater. So in summer also you made money, in winter also you made money. Okay, but these two products are negatively correlated, right? So you take ice cream, it is something like project A. If you take raincoats, it's like project B. When you combine both these things together, you get a cash flow like this. Okay, so we'll see in reality how this works. So we'll have an example of this. The price of Bank of Baroda, SBI and ICICI, all of them are banks in India. So the price from 2003 to 2013 I have taken. So the red is Bank of Baroda, orange is SBI and blue is ICICI. If you see, all of them are moving similarly, even though they are like higher or lower. If you see, they are working in a particular kind of a pattern. Whenever they go up together. Whenever they fall together. Whenever they go up together and fall together. So if you can draw a pattern, the pattern is always within this kind of a boundary, right? So this is how they work. So why they are like this? Because they are positively correlated. All banks are positively correlated. So you can't buy these banks and say that my risk is gone. Your risk is diversified, but it is not gone. Okay, what can you do to prevent this? We'll have another example. This is the price of gold and Nifty. Okay, gold and Nifty are negatively correlated. The red color line is the Nifty or the Nifty represents the country's index, stock index, and the blue color refers to the gold price. So if you see that whenever the gold price goes up, the share prices fall. Whenever the gold prices go down, the share prices go up. Okay, so it is a negatively correlated assets. So when you have both these things together, your risk is like diversified. What correlation between returns on shares will best reduce the risk? So which one will reduce the risk? Perfect positive correlation? No. No correlation? No. Perfect negative correlation? Yes. Weak correlation? This is yes, but when compared to this is the right one. So the answer is C. So we'll move on to the next one. So now we'll discuss about beta. So in that graph we found out that systematic risk can be measured through something called as the beta. Okay, so imprint in your mind that beta measures the systematic risk. Okay, so beta refers to the higher the beta factor. Beta is a number. The higher the number, it tells you that the company is more volatile, the company is more risky. Okay, so we can put it like this. If beta is higher, that means the risk for the company is also higher. Okay, so that's how they are correlated. So we can also say like that, if the beta is more than 1, okay, the company's share or the company is more volatile than the benchmark is something like Nifty or Sensex. So the company is more volatile than the benchmark. If it's like equal to 1, okay, the volatility is in line with benchmark. Okay, so always the beta for the index of any country is stated at 1. It's fixed at 1. So in relation to the index only, we are trying to find out the beta of a company. Okay, so if the beta is between 0.0 to 1, then it is less volatile to the benchmark. If it's 0, then it's not related with the stock at all. Okay, with the index at all. So mostly the case would be here only. This is not a usual case. So we'll see in reality whether this works. So just go through these companies. If you go through these companies, try to find out which companies are like very stable businesses. If you take Adani Ports and SEZ, ports are depending about global trade. So global trades are fluctuates, but paint companies don't fluctuate. Banks usually fluctuate. So we'll mark it into. Banks usually fluctuate. Auto companies don't usually fluctuate a lot. Finance companies like banks always fluctuate in their income, their profit. Bajaj Finserv, so Bajaj Finserv also fluctuates. It's a finance company. Petroleum companies, they also fluctuate because the crude oil price fluctuates. So this is also a fluctuate company. Airtel will not fluctuate because the total number of calls we make and the time we speak is usually stable. Bharti Infratel is an infrastructure company which is supporting Bharti Airtel, so they won't also fluctuate. Now just look at this implication. Wherever we marked the into as wrong, the beta would be higher. Check. And wherever we tick mark, the beta will be less than 1. Check. The less than 1. Asian Paints is less than 1. Bajaj Auto is less than 1. Bharti Airtel is less than 1. Bharti Infratel is less than 1. But if you take companies which we have marked as into, that is the companies which are highly risky, okay, highly risky, they will have more than 1. Check. 1.71, 1.42, 1.54, 1.62, 1.63. Okay, so we have found out that the index of a country is set at a beta of 1. So Sensex or Nifty in India are set at 1. So any company more than 1, having a beta of more than 1, are more risky. Any company having a beta of less than 1 are less risky. Okay, but is it right to think like that? The answer is yes. The beta factor reflects the fact that different sectors and markets and individual companies within each market sector, so the industry as well as the companies, have different degrees of systematic risk. Okay, so every company has a different types of systematic risk, every industry has a different type of systematic risk. So if you take a company like supermarket, so supermarket companies are not much affected by the unsystematic risk, hence they have a low beta factor. For example, the political risk or the inflation risk or the interest risk or the economic risk will not affect the supermarkets a lot, so they have a low beta factor. On the other hand, if you see a company like banking or tourism, these companies are heavily influenced by political interest, inflation and economic risk. So these are heavily impacted, hence they have a higher beta. Okay, they are greater degree and they have a higher amount of beta. Okay, so you can put it like this: companies which have less systematic risk will have lower beta, companies which have high systematic risk will have high beta. So what are the factors which determine how high or low a beta will be? So that is the systematic risk. But apart from that, how can we find it out? So you can take things like stability of cash flow, operational gearing, and financial gearing. Operational gearing refers to the fixed cost a company has. Okay, the level of fixed cost a company has. Financial gearing refers to how much debt a company has. So if a company has a high stability in cash flows, the share price movement will be very low, right? And the beta will be very low. If a company has a high amount of fixed cost, these companies are risky, so the share price movement will be high and the beta will also be high. If a company has a high amount of debt, the share price movement will be very high and the beta will also be very high. So this will tell you an indication of how these factors also contribute to the beta, right? That's why if you take a supermarket which has a high stability of cash, okay, low operational gearing, low financial gearing, will have a low beta. So we look at the CAPM formula. So the CAPM formula works like this: the expected return, okay, so that we can take it as the KE. So the expected return is equals to RF plus beta into expected return from the market minus RF. So the expected return is the KE here. RF is the risk-free rate of return, that is nothing but the treasury bill rate. ERM, expected return from the market, is the index return, and BI is the beta factor for that company. So if you are going to find out the beta for Britannia company, okay, the beta for Britannia company we have to search for. So this is the format. So what are the CAPM propositions are? CAPM states that every investor in a company, okay, wants a return which is in excess to the RF to compensate the systematic risk. For example, the formula was like this: RF plus beta into RM minus RF. So there are two parts. Investor wants definitely RF plus additionally a premium for the risk he takes with the company. So investors should not require a premium for unsystematic risk because that is diversified. So they should not ask any money for that, and they should only ask a return for the systematic risk. So how do you know how much systematic risk the company has? Systematic risk is measured through beta. Systematic risk is measured through beta. Because systematic risk varies between companies, investors will require a higher return from shares where the systematic risk is higher. So whenever a company has a high risk, the beta will also be a higher number. The beta will increase the return for the share. So we can put it like this: Assume we'll take two companies. So one company is a supermarket company and the other one is a construction company. RF for both the companies is 10 plus, okay, RM is again it's around some 15. So RM minus RF, again the formula is RM minus RF. Assume we just now discussed that supermarket companies usually have a very low systematic risk, so their beta will be low, so we'll take it as 0.5. Construction business usually are very risky business, hence their systematic risk is higher, hence their beta is higher, so we will take 2. Let's see what is the KE for these two companies. Okay, what is the KE for these two companies will be. So here we solve this, 5 minus into 0.5 it comes to 2.5. So the KE for supermarket business is 12.5, 10, 20, and the KE for construction business is 20. So you can, so if you look at this formula, the only number which is keep changing is the beta. So beta is the fundamental block of CAPM. Okay, so you see that RF is constant, RM is constant, again RF is constant. The only thing keeps changing is the beta. Okay, so this should give you a good idea. So the same propositions can be applied to the capital investment by companies. So companies will want a return on project that is more than the RF. Companies also need more than the RF because they take risk. Unsystematic risk is usually diversified, so they should not ask for a return for that. Companies want a bigger return on a project when the unsystematic risk is higher. If the beta of the project is higher, they need a higher KE. Okay, but what are the problems in applying the CAPM in practice? There are like a huge amount of problems. The formula itself is a problem, and you can apply what are the problems with CAPM in terms of the formula. So ERM, so the formula worked like this: RF plus beta into RM minus RF. The formula of this gives you the expected return from the individual security. So ERM, see what we are computing is expected return is needed rather than the tail return. Okay, so the expected return, this the RM here, that itself is expected, not historical. Historical means you can find out from database, but expected is again something which you expect in the future. So how do you forecast that? That itself is a problem. RF is treasury bill rate. Okay, RF is risk free rate of return, which is treasury bill rate. Treasury bill rates actually change with the time period of lending. There are treasury bill rate for 1 week, 1 month, or like 1 year. Then in that case, how will you find out the rate? Betas also change over a period of time. So a company will not have the same beta for 5 years and all. The beta for 1 year will be different from the beta for 5 years. It is a single period model because all these are in a particular year only. They can be little bit constant. Beyond a year they will become different numbers. So the KE that you find, the KE that you find with CAPM is valid for only 1 year. Next year you have to again recalculate it and the answer will be different. There are errors in statistics because the entire model is based upon statistics. Beta of one company cannot be used for another company. You can't take Bajaj Auto's beta and apply it to Hero Honda and all. Even though they are two-wheeler companies, you can't do that. These are the problems. And there are problems like this. You can't use one company's beta for the other one just because the cost structure of companies are different. So Bajaj and Hero Honda are not same. The size of companies are different. The depth of companies are different. The growth rate of companies are different. So you can't take two companies which are very similar. They don't exist at all in the real world. So we'll have a question here. What happens to a company's VAT if the firm's corporate tax increases, okay, and the Federal Reserve causes an increase in risk-free rate, okay, so respectively? Consider the events are independent and assume a beta of less than 1. So he says, if corporate tax increases, what will happen? Tax rate increase, cost of debt will go down. So that will decrease the WACC. So both this and this are right answer. So if RF increases as per CAPM, if your RF increases, okay, this number increases, then it will beta RM minus RF. When this number increases, it increases the overall KE. So when RF increases, KE will also increase. When KE increases, WACC will also increase. So the answer is A. We tick marked both decrease WACC and increase WACC. So the answer should be A. So the answer is A. So these are the questions which have been asked in the previous examinations. So this is in December 16 and June 14. So just go through these questions, you'll get a good idea. So thank you very much for watching this video. We'll meet in a next video.